Um, at least the accountants will still have jobs doing their accounting, but there's a whole special subsect of people that actually do the tax work. I bet you the CPAs would really not mind giving up the tax work, to be honest with you, because the audit work should be enough to keep them busy, and that's funner stuff.
Busy season.
Yeah, then you'd get rid of the busy season, because that's, every accountant that I know works the tail off, the first 3 months of the year, and then they take a month off at some point during the summer, right?
Fridays off.
Yeah, they do tend to get some sort of compensating time off for that. But you think it equals out? Yeah, no way.
No reflect.
All right. So the first thing I have to do is I have to apologize for not posting a homework assignment for you guys. Sorry. So what we'll do instead is we will just go over a couple more examples of the M1 and the reconciliation of retained earnings in class. How about real estate is the basis of all wealth and power in the United States? I do like this one though, because that's our one. Planning's where the money is. All right, so I'm going to put my little fact situation on the board here. What kind of business is McDonald's? Generally, it's a franchise corporation, but it's franchised. So you bring in a couple of different things there. You get corporate stuff, so you're going to have all your corporate things. I would wonder if at the local level where you have the franchisee, whether they would be a subchapter S corp. I'm going to bet you they're all going to be corporations. Certainly, McDonald's at the top level is going to be a C corp. But yeah, at most, I would think a great majority of the McDonald's stores are indeed franchisees. I don't know how many the corporate itself operates. I'm sure they operate some, but I'm sure it's a small percentage. I'm going to make those markers more. Who's the lady that's rich? I need to know.
Somebody.
All right, so net income per book, 550,000. Appreciation book, 25,000. Return, 40,000. Federal tax book, 100,000. Capital gain, 25,000. Travel and entertainment, 5,000. Distribution, dividends, cash, 350,000. And tax exempt interest, 15,000. Okay. Let's get up in 1120. Page 6. Okay, so this is the page 6, the M1 and the M2 on the 6th page of the 1120. So let's take a look at our fact situation, which isn't a lot of information, but that's fine. That's all we need. Net income per book is 550,000. That's going to go on line 1 of the M1, 550. Right. Depreciation per book and depreciation per return. All right, so there's a difference on the two of $15,000, right? So that's a reconciling item when it comes to our M1. So we have more expense on the return than we do on our book. So we have depreciation on 5A and on 8A. 5A says expenses recorded on book, not on this return. Is that what we have here? Do we have expenses that are on the book but not on the return? No, I think we have the exact opposite. We have $15,000 of expense that's on the return that's not on the book. That goes on line 8. Deductions on this return not charged against book. So 8A, I believe, is where the $15,000 goes. 8A. The next thing is federal tax per book. I would go on line 2, federal income tax per book, 100,000. Capital gain of $25,000. Federal income tax, excess of capital loss over capital gain. Is that going to go here? No, this is where we would have a capital loss. I just threw that in there as a red herring to say, oh, wait a minute, does it matter if we have a capital gain? No, that's not a reconciling item. Because why? Well, why is it not a reconciling item? Austin, why is it not a reconciling item that we need for M1? What are we reconciling? We're reconciling book income against tax return income, right? Okay, so why don't we have to reconcile that number? What's that? Which one? Connor, what do you think? Why is it not a reconciling item? Yeah, it is recorded on the book and the tax return the same. It's only a reconciling item if it's different between book and return. Okay, so for example, the travel and entertainment that we're going to come up with here, that's been recorded on the book, but we're not allowed to record it on the tax return. It's not an allowable deduction. So that means that we kept our books different between the book and the tax book. Okay, the capital gain is recorded as a gain on the books of the company and was recorded on page 1 of the return. Okay, if it was a capital loss, then it's recorded on the books of the company, but we're not allowed to take the deduction on page 1 of the return. That's the reconciling item. Gain, not reconciling because we did have to report it and pay tax on it. Okay. Yeah, we're only reconciling if we have a difference between book and return. Okay. All right, so that was just a red herring. The capital gain is of no importance to us whatsoever. Let's call it entertainment. I have T&E there, but entertainment will say it's $5,000, and that has to go on line 5C. Dividends. We paid cash dividends of $350,000. Well, that's going to go on M2, line 5A, 350,000. And then tax exempt interest of $15,000. That goes on line 7. And then it gets carried over into the total column here. All right, we don't have anything else that we need to put on the return on the form here. First thing we have to do is come down here to line 5 and total across if we needed to. So we have $5,000 of entertainment that we couldn't deduct. So now basically we're talking about sure that I'm doing everything right. Yep. 550 plus 100 is 650, plus 5 is 655,000. The total for line 6 on the M1. On the opposite side, we have the tax exempt interest that we extended over. We have the depreciation on line 8A that we have to put into the total column. That gives us for line 9, total 7 and 8 of $30,000. Line 10 is purely math. Line 6 of 650,000 minus line 9 of 30,000. So that's $625,000. Now, if we had the rest of the return, we would take a look to make sure that line 10 on the M1 agrees with the taxable income on page 1 of this return. But we don't have the rest of the return, so we'll have to just assume that that's correct. All right, M2. Oh, I guess I have to give us a beginning and ending balance. Let's say the beginning, I didn't put that up there. Okay, beginning balance, let's say was $1,250,000. Right, we're going to calculate the ending balance. So line 2 is net income per or loss per book. We have a net income of 550,000 per book. We don't have any other increases that we would put on line 3. So line 4 is the total, 1,250,000 plus 550, $1,800,000. Okay, on the right-hand side of this equation on M2, we have distributions of cash on 5A of $350,000. Those were the dividends. We don't have any other decreases. So the total on this side is going to be the $350,000. So subtract 7 from 4, 1,800,000 minus 350,000 is $1,450,000. Yeah. So I made this out to be a real monster, the M1 and the M2. They're really not. It's just that in a normal doing this in the real world, these numbers you have to get them from somewhere, don't you? You're going to have to look at your book, see what your net income per book is. You're going to have to pull all of these things out of the information of the company in order to be able to do this reconciliation. But really, when you have the numbers, they're actually very easy. Okay, do another one, just for the sake of doing another one. All right. Basically the same information, with different numbers. All right, so net income per book, 325,000. Depreciation per book is 10,000. The return is 7,500. Federal tax per book, 60,000. Capital gain is now a capital loss, 5,000. Entertainment, entertainment is 3,000. Dividends, cash dividends paid is 200,000. Tax exempt interest is 5,000. Oh, in this one, we have a carryover of a charitable deduction from the prior year of 8,000. And our beginning retained earnings was 750,000. I'm just going to reload the 1120. All right. I'll let you guys do it this time. Net income per book goes where? Line 1, that's right. That's 325,000. Okay, depreciation per book and per the return, it's 10,000 and 7,500. So that's a difference of 2,500. Now, is this going to go on line 5A or 8A? Expenses recorded on books this year not deducted on this return. So the book is higher than on the return. So yes, we're going to have 2,500 on line 5A. How can that happen? How can we have more depreciation expense on the book than on the return? Isn't the tax law, designed so that we expense things out quicker at the beginning? So our depreciation should always be higher, right? Why not, Andrew? Or, excuse me. Why not?
After you fully tax, still like.
That's right. Yeah, that's right. So we can have a situation where our book is going to be higher depreciation than the return. So that's what we have here. So yes, that goes on line 5A. All right, federal tax per book goes where? Line 2 of the M1. That's what, 60? Okay. Then the next one is capital loss of $5,000. Goes line 3. That's right. All right. Entertainment of $3,000. 5C, that's right. Dividend distribution of 200,000. Yep, 5A, correct. All right, tax exempt interest of $5,000. Line 7 of the M1. 5,000. Carryover of a charitable loss of $8,000. I think that's 8B, don't you? That's deductions on this return not charged against book income this year. So if it's a carryover, that means it happened in a prior year. So it's not on this year's book, but it's on this year's return. So that means it's an expense on the return. It's not on the book. So that is definitely 8B. It's a charitable contribution of $8,000 of a carryover. All right. Retained earning beginning balance goes where? M2 line 1, $750,000. Okay, we should be able to calculate this out now. Line 5 has two numbers in it, the 2,500 and the 5,000. So we have to add those together to get to the total of line 5. Now we need to add everything together to get the line 6. So it's the 325 plus the 60 plus the 5 plus the G&E. I have 5,000. That should be 3,000 on line 5C. Change that. Make it correct. Typing the problem. It's 5,500. Okay, adding all that together, we end up with what, 395,500. Okay, we have to extend line 7 over into the total column, so that's 5,000. We have to extend the 8,000 on line 8 into the total column. All right, so 8,000 plus 5,000 is 13,000. To get to line 10, we subtract 9 from 6, so 395,500. minus 13,000 is 382,500. Right, coming down to the M2. We have the balance at the beginning of the year, net income or loss per books. It's just listed above us here on schedule M1, line 1. So that's 325,000. Okay, we don't have anything else on line 3, so there's nothing there. Line 4, we just add those two together. So that's going to be what, 1,075,000? 1,075,000. All right. On the right-hand side, we have the $200,000 that we distributed in dividends. We don't have anything else on that side, so that's going to be our 200,000 totaling on line 7. Line 8 will be line 4 minus line 7, so that will be 875. Oh, why don't I ever do that? $875,000. Sure, put it in the right line. That really wasn't that hard, was it? So you just have to know where to find these numbers. It's obvious, pretty easy when I just give you a list of the numbers you're going to use. It's just going to be a little bit harder when it's the overall. Here's everything you need to do an entire 1120. Because then this stuff's going to be buried in a whole lot of other information. But it's not really that hard. Now let's talk about what some of this means. And one of the things that I like to do when I'm, and I guess it's because I used to be an accountant, but I like to find ways of checking my work. See, does it logically say what I think it should say? Okay. So, for example, on the analysis of unappropriated retained earnings. All right. So, what's going to affect retained earnings? Realistically, I guess if we had some sort of a distribution of capital, that would be something that would be over on line 5, other than cash. But in a normal year that you're running a business, what's going to affect retained earnings? What was the third one? Investments? Would investments affect it? Yeah, retained earnings. Would it affect retained? Would investments affect retained earnings? Oh, if somebody invested in the company and you sold some additional stock. Okay, yeah. All right, that would be other increase. Okay, that makes sense. That makes sense. Okay. But in a normal year, you're going to have income and you're going to have distributions of dividends. Really, all that really should happen to retained earnings. All right, so balance at the beginning of the year, 750. The only thing that's going to affect it is net income. And we know from the book that we have a $325,000 net income per book, and we know we distributed 200,000 to our owners. So that means we decided to keep 125 in the business. So our retained earnings should go up by 125. I feel good about that now. That's a double check for me. Other things up here, for the M1, is there any type of a way of saying, oh yeah, I knew that was going to happen? Well, again, I don't think there really is. This is kind of, I don't know that there's anything particularly intuitive up here. Oh yeah, I knew that number. I guess you might have an indication as to whether it should go up or down. If you have more adjustments up or more adjustments down, that you may have a feel for that. But I guess really the only way of checking your work is to compare line 10 to page 1. Then you absolutely know if you're right, if it matches. If it doesn't, then you have to start doing some poking and prodding to where the error is. The other thing is, we talked about that when I threw in that crazy capital gain and asked you where that should go. It's only things that are requiring reconciliation. It's things that are on one of the two reports. Just think of it as you have two income statements. You have the income statement that you keep according to accounting rules. That's your book. And then you have the income statement that is the first page of this return. We know that there's different rules. Depreciation is not, is going to have a different set of rules, either higher or lower. We know that some things are not deductible, so that is a reconciling item. We know certain things aren't taxable, like tax exempt interest. That's going to be a reconciling item. It's only going to be on one of the two income statements. If it's on both income statements, like the capital gain, you don't reconcile. It's only on one of them because it's reported on the return, but not on the book, or it's reported in the book, but not on the return. Then we reconcile. That's all. You try to get an intuitive feel for what types of items will need to be reconciled. They're all there. Really a limited number of things, right? We do have some blank lines where you can try and come up with something else if you want, but that's what you should see on a regular basis. Tax exempt interest, perhaps. Depreciation changes, perhaps. Things that are not allowed as a deduction, such as entertainment, that's going to be a reconciling item. Any questions? I think that, do you feel that you've seen the entire return at this point? Do you feel that it's something you can handle? We did do a class ago, we did do the entire return. I was actually surprised we got through that in one class. I expected that to take more than one class, but it went so well that we got it all done in that one class. Any questions or anything that you don't feel comfortable about with the actual 1120 or any of the supporting schedules?
Where is that line? Is there another way to check line 8?
Check 8
or 8 for him?
Oh, down here? Yeah, it's easy. It's going to be right up here. Yeah, because you're going to have your balance of your retained earnings on your balance sheet. So to check line 8 of M2, you would check that against retained earnings unappropriated, line 25, ending balance. So yeah, you'd know you're right if that matches there. Line 10, it says it should equal line 6. Well, it should be equal page 1, line 28. So if we go back to page 1, line 28 is labeled taxable income for NOL. Okay, so an NOL is obviously not something that's on this year's return, on this year's book. So, but yeah, there's ways of checking your work that if those things match, then you know you have it right. In the real world, you might end up with some rounding issues. So if you're off by $4 or $5, you might want to just say, I'm okay with this. Probably have to put some sort of a rounding figure in there because the IRS may not be happy with the $4 difference, but you may end up with a $1 or $2. I understand it. Materiality says you're not going to spend two days looking for it. The guy that I was talking about that's refused to make estimates of things at the end of the year, he would chase down that $3 for 3-4 days. Yeah. He was a great accountant and everything had to be perfect for him, but he did not understand the concept of materiality. Okay. So that I'm not sending you out with only a half hour's worth of content today, let's take a look at the next thing, although it's not, we're going to have a text on Tuesday then, right? Test on Tuesday is going to be just like what we did the other day. It's going to be the entire 1120 with all of the supporting schedules. Okay. We were able to get through it in class with me yammering on and on and on. So you guys should be able to get it done during class time. Obviously, if you need more time after class, I'll stick around and let you have some additional time because I got a couple hours off after this class, so I can be here if you need additional time. All right, so that being said, let's move forward to another thing. Let's look at the 1120S. All right, the 1120S, it's going to look a lot like what we looked at just a few minutes ago. But it's not exactly any change by any chance. So we're going to have our taxpayer information at the top like we should. We're going to have employer identification number, date incorporated, total assets, all the same as the 1120. We have different choices on the left-hand side here. We have S election effective date. Because see, you aren't automatically an S corp. If you incorporate, you are automatically a C corp. What you have to do is you have to elect S status. Okay, so there is going to be a date in which your S status is going to be effective. That's the date you're going to make that election. You have to send a form into the federal government. You have to send a form into your state government, informing them that you are electing S status. Now, you don't have to elect the F status at the time you form the corporation. You could decide to run as a C corp for a while and then change to an S corp. That's fine. Most people don't. Most people want to make the election right at the beginning. Most of the companies that I deal with are smaller companies. I have to admit, I've never incorporated IBM or Amazon or anybody like that. You know, I've incorporated some small stores and some electricians and some construction companies and so on and so forth. And they elected S status right at the very beginning. Okay, so when I incorporated those businesses, I filed my paperwork with the Department of State to get the corporation into existence. My style would be that I would wait until I got my paperwork back from the state telling me that I am indeed incorporated under that name. Then I would apply for the taxpayer identification number, the EIN, for the company, for the corporation. And at that time, I would apply for S status, which is filing a form with the federal government, with the IRS, and also I would do the same thing in Pennsylvania. There's another form you have to file to elect state S status. Okay, so there's going to be a date that you have chose S status. Now, the way the rules are, and I'll be very honest with you, I don't remember them off the top of my head. In order for the S status to be effective as of the first day of business, you have to make the election for S status within a certain number of days of beginning business. You can't just wait until the end of the year and go, oh, I forgot, I should have elect that status now. You're going to be in some trouble if you try to do that. I think you have 60 days. Don't quote me on the 60 days. But I think you have, if you elect that status within the first 60 days of existence, it will be retroactive to the first day. That's why I never had any problem waiting for the approval from Pennsylvania before I asked for S status. I'm just one of those guys. I worry that even though I know that the name is supposedly available because I've gone through all that, sometimes I just think that by the time the paperwork is processed, somebody else will steal my name and I'm going to get bounced back to me. Oh, you can't have this name. And then I'll have done all this work under the wrong name. I don't want to do that. Some questions to answer. GHIJ, is the corporation electing to be an S corporation beginning with this tax return? If this is your first time as an S, then say yes. Age, check if it's a final return, a name change, an address change, if it's amended return, or you are terminating your S election. I, enter the number of shareholders who are shareholders during any part of the tax year. So you have to report the number of shareholders. One of the reasons for that is that there is a maximum number of shareholders you're allowed to have and remain as an S corp. That's why the big, multinational corporations that are traded on the stock exchanges aren't S corp because they are not allowed to be too many shareholders. Okay. J, check if the corporation is an aggregated activities, 465 at risk, grouped activities under section 469 passive activity purposes. Once again, if you're a very specialized corporation, you'll know what that means. Check those or not. Yes, sir. Can you what? No, not at all. You can be a massive corporation with thousands of employees as long as you only have a certain number of shareholders. Can an owner of an S corp be an employee of an S corp? Start back. Let's go back. Can an owner of a C corp be an employee of a C corp? Absolutely. We saw that. We reported
for example, the officers, they were, the examples I gave you, they were all shareholders, right? They all owned some share of common stock. But yes, as a C corp, officers and shareholders can be employees. Can officers and shareholders be employees of an S corp? I'll go one step further. Can officers and owners of partnership be employees? From accounting purposes, do you have an answer for that? Have you ever done any of your accounting classes? Have you done any partnership stuff? Okay, well, if you haven't done any partnership stuff, that's fine. So I guess I'll be the one that teaches you that. If you have a partnership, the way you keep the books, you don't have retained earnings. You have partnership ownership accounts. You ever seen that? Okay. So what happens instead of retained earnings, you have partnership capital accounts. So you're going to have, if there's two partners, you're going to have Bob and Jim. Bob's going to have a ownership account, which is basically the partnership version of retained earnings. When you get to the end of the year, we have to close out the income statement. And that's what when you close out an income statement for a corporation, you take all the expense accounts and you reverse them. You take all the revenue accounts and you reverse them. You set everything back to zero as of the first day of the tax year. And you need an entry to balance that journal. You need a number to balance that journal entry, right? And that's your net income that gets closed into retained earnings. Okay. You don't have retained earnings in a partnership. You have these partnership capital accounts. So each partner will have his own capital account that will act as their own personal retained earnings. Okay. All right. Since you guys haven't had any real partnership, yes, sir. Yes, and in the most simple way, if it was a 50-50 partnership, then yes, that's exactly what would happen. And that income would be split in half. Half would be put into Bill and half would be put into Jim's partnership capital. Okay. You could have three partners that would be split by three, or you could have an uneven ownership in the partnership, and that's going to be driven by the partnership agreement. You may have one partner who ends up getting 3/4 of the income, that's 3/4 of the work. So you'd split the net income 3/4 and 1/4. But it's like retained earnings, but we have individual accounts for each of the partners. Partners are not allowed to be employees of partnership. Okay. The reason for that is the legal stance of a partnership is very similar to the legal stance of a sole proprietorship. A sole proprietorship, you are the business, right? You're just, whatever it is that you're doing, you're running that business and you are the business. All of the income belongs directly to you. All of the expenses are your responsibility. You don't have a separate tax return for sole proprietorship. You have a Schedule C that you have to put on your stock. Okay. There's a Schedule C that you have to add to your 1120 to show your business income. But it's not a separate return. Okay, a partnership is the same thing in that you are the business. There's two of us in business. There's not a separate legal entity that is the business. Partners are the business, but as a result, you can't pay yourself income. But I'm already the business. I can't pay myself salary. When we do the 1065, you'll see there's a lot of weird rules around partnerships. We'll get to that in a little bit after the 1120 else. But because a corporation is formed as a separate legal entity, whether it's a C corp or an S corp, it is a separate legal entity, separate and apart from its owners. Therefore, the owners are allowed to be employees. That makes sense? If you are the business, then you can't be an employee because you are the business. So proprietorship, partnership. Okay. So the reason I ask that is, although for tax purposes, the S corp and the partnership look a lot alike on a tax form. You're allowed to be an employee of an S corp. You're not allowed to be an employee of a partnership. If you're an owner, partnership can have other employees, not an owner. Okay. So, Bill? All right, so the 1120S, let's take a look at what kind of numbers we're trying to accumulate here. All right, just real quick here. Doesn't that income section look a lot shorter than it did on the 1120? I see 6 lines and line 6 is total. There's 29 lines, wait a minute, 11 lines. Line 11 is the total on the 1120. So we have a lot more categories of income on the 1120 than we do on the 1120S. Okay, let's look at them. Gross receipts or sales, okay, that's the same. Returns and allowances, that's the same. 1C, that's going to be our net revenue or net sales, right? So sales minus return, that's the same. Cost of goods sold, look at that. Attach 1125A. We've done that to come up with line 2, and then line 3 is gross profit. Everything is identical for the first 3 steps of this return. Line 4, net gain or loss from 4797, line 17. That's the same as we've done on the corporate return, the 1120. So nothing has changed through the first 4 lines. And then we get to other income or loss, see instructions, attach a statement. That's going to be that miscellaneous thing that you'll always have a possibility of using. I don't have a problem with it, but that's not everything that's missing. It's what you would refer to as miscellaneous income. Then we get to total income. What's missing here? Really not. What don't we have? Well, let's go back to the 1120 and see. I know it's really hard when you look at something and say, well, what don't you see? Well, wait a minute. No, let's actually look at the 1120 and compare. Royalties is missing. It's one of them. All right, so gross receipts, returns and allowance, balance, cost of goods sold, gross profit. All right, dividends and inclusions. Can a partnership own shares of a corporation and get dividends? Yes, but it's not reported online on page 1. Does that mean that it's not taxable to the partner, the C corp? It's taxable, just not there. Okay, so let's see what else is missing. Interest. Interest isn't on here. Huh. Gross rents. No, that's not on the 1120S. Gross royalties, as Austin brought up, that's not on the 1120S. Capital gain from Schedule D is not on page 1 of the 1120S. That mean capital gains aren't taxable? Austin, tell me. Capital gains not taxable then? They're taxable. It is not there. That's correct. All right. Net gain or loss from 4797. Aha, that is on the 1120S, right? There's the 4797 on line 4. Other income, okay, we have that on the first page of the 1120S. So we have a bunch of categories that are missing. We have capital gains, we have rents, we have royalties, we have interest, not reportable here. Where do you see the word comprehensive? I don't know that I have everything comprehensive on a tax book. What? Well, what am I going to say? It's not tax law. Okay. Yeah, there's I don't think the comprehensive is even defined in the tax code.
We don't care about gap here, do we?
Not at all.
What do we, what the, you guys out in the accounting world, you guys are slaves to gap, right? We in the tax world, what are we slaves to? Correct. The IRC, the Internal Revenue Code. Absolutely right. All right, so we know we have some things missing here. Let's keep going. Let's see what the deductions look like. Are we going to have a whole lot of deductions missing? All right, line 7, compensation of officers, attach 1125E. Hey, we've already done that. So that's nothing new. Salaries and wages, okay, we saw that on the 1120, right? That's for our administrative and overhead people. Repairs and maintenance, bad debts, rents, expense, taxes and licenses, interest expense, depreciation not claimed on 1125A or elsewhere. So depreciation is an expense that's going to be out here. Depletion, don't deduct oil and gas depletion. Advertising, pension, profit sharing, employee benefits, and other deductions. That look pretty complete to me. Composition officers, salaries, repairs and maintenance, bad debts. So maybe did we see bad debts? Yeah, we did. Rents, taxes and licenses, interest, charitable contributions. Are the S corps not allowed to make charitable contributions? Not there. Depreciation, okay, that's the same. Depletion, that's a separate line here on the 1120. On the 1120S, it doesn't appear. Advertising expense, yes, that's there. Pension profit sharing, that's there. Employee benefits, yes, that's there. Reserve for future use is not there, but I don't know if that matters. And then other deductions, attached statement, we do have that. So we have a couple things that are missing, right? All right, then down here, I'm going to talk about that later. Okay, where are the missing income and expense items? As accountants, should it matter to you whether you're a C corp or an S corp the way you keep your books? No. Hey, you're following GAAP, right? So if you had charitable distributions, you're going to record them. If you had capital gains or losses, you're going to record them. If you had rent or interest or income, you're going to report them. Now, that's true, but something inside you should say that at least on the income stuff, which you did say, Austin, it's going to be taxable. It's just not here. What we have to do is we have to figure out where it is. Do you think it's going to be in this return, or do you think it's going to be somewhere else? It's going to be what? Perhaps. Let's keep going. I'm going to ignore the bottom of the form for right now, bottom of page 1. Schedule B. Check accounting methods, see instructions and activities at any times with any shareholder at the end of the tax year did the corporation. Ooh, have we seen these questions before? Right there. So these questions about ownership and methods of accounting and things like that, they were on Schedule K of the 1120. And if you remember, when I went over this, I said it's labeled as Schedule K, but as we move forward into every other tax return that we're going to be looking at, Schedule K has an entirely different purpose. Okay? So on the 1120, Schedule K, this is just that questionnaire. On the 1120S, Schedule B is the questionnaire. Okay? Well, what was Schedule B on the 1120? There was no Schedule B. We went right to Schedule C, which was dividends. And then we had Schedule J, computation of taxes. D is another form, right? All right, continuing. So Are these important on the tax return? Yes. Should you complete these when you complete your tax return out in the real world? Yes. Are we going to waste time with that in this class? No. Understand they're there. Understand you have to answer these questions in order to do a complete tax return. I'm not spending time with it. You guys can do it in the real world easier than I can try and teach it here. I'll get my my PTIN suspended for that. All right. Oh, wait a minute. After Schedule B is Schedule K. Are we going to end up answering questions about the corporation again? No, because the Schedule K on the 1120S actually is a very important schedule. It's another income statement. There they are. There they are. Ordinary business income from page 1, line 21. So if we go back to page 1, and let's take a look at everything that's there. If you look at the income and expenses that are listed here on page 1, how would you generalize? If I asked you to generalize what is here, what would you say it is? Not everything, no, but what is that? Is interest income part of your core business? Is rental income part of your core business? Unless you're a bank or a company that does rentals and things like that, you know. But if you're a manufacturer, those things that are missing from here are not your core business. This is what you would consider to be your ordinary operation, wouldn't it? Cost of goods sold, salary, expenses directly related to the running of your business, your overhead, and those types of things. But it doesn't have that ancillary stuff. That's the difference. This is purely your operation. And so, for whatever reason, and this is the reason that is, well, I know why, because the IRS, I tell you, about categorization. We're categorized. All that other income that's up there that's not being reported, that's passive income. Running a business is active, right? Are you being active in the running of this business? Well, I'm selling, I'm manufacturing, yeah, you're active. I got some interest coming in from some investments that I bought in the business. Is that active or is that passive? So what's happening here is we are categorizing income and expenses into that which is directly related to the operation of your business, which is everything on page 1. And then on Schedule K1, we're going to pick up all that other stuff that your business is doing that isn't directly related to its operation. We're going to separate out active versus passive income and expense. Why? Austin, I know you had a question, but I'm going to ask you mine first. Okay, why? Say that again? Do we have a flat tax here? We didn't talk about that here yet. No, we don't have a flat tax here. Passive, well, not necessarily. It's going to be taxed as ordinary. The reality of it is that you're not allowed to take passive losses against active income. Because active income is taxed at the highest rate. Passive, we don't want you to get a tax break by losing passively against income that is active. That's why the IRS wants to make sure that if you have passive losses, you can only take it against passive income. Categorization. Okay, let's go back to Schedule K, knowing that page 1 of the 1120S is your direct operation of your business. Let's look at what's on Schedule K.
Ordinary business income from page one, so that's our direct business. We're gonna have our income or our loss right here on line one. Net rental, real estate income. So if we have, real estate that we're renting, which is not directly related to our business, that it's at ancillary, which would be considered passive income or loss, on line two. Other gross rental income, could we rent other things? Yeah, I guess I could rent equipment, I could rent out my car, I could, a whole bunch of stuff I could rent other than real estate. Expenses from other real estate activities. So gross rental income reported here, and expenses against that other income is reported separately. Line C, other rental income, subtract 3B from 3A. Line 4, interest income. Okay, so there's that interest income. Once again, is that directly related to our business? Am I a bank? I'm not a bank, not directly related to my business. So the income here is something that's not part of this. 4, 5, dividends, ordinary and qualified. 6, royalties. 7, short-term capital gain or loss. Long-term capital gain or loss. Oh, by the way, Schedule D is now going to be for Form 1120S. We have a different Schedule D. Collectibles are taxed differently than other long-term things. Unrecaptured Section 1250 gain. Oh, what's that? Net Section 1231 gain loss, Form 4797. Other income. Okay. Deductions. Section 179 deduction. Wait a minute. Didn't we have depreciation on the first page? Yes, we did. Line 14 was depreciation. We took a 179 deduction. It's not going to be in depreciation. It's going to be on this line here. Charitable contributions. Oh, there they are. Charitable contributions, investment interest expense, Section 59E2 expenditures. I don't know what that is off the top of my head. Other deductions. Put them in there if you want to detail something out. Credits. We can talk about credits. We're not going to spend a whole lot of time talking about credits in this class, but low-income housing, qualified rehabilitation expenditures for real estate, other rental real estate credits, other rental credits, biofuel producer credit, other credits. So we can have other credits that are going to be over here. Wait a minute. Don't credits get used against our tax? They do. So we should get to a point here, there should be a schedule here where we calculate our tax and then take the payments that we made against that tax, estimated payments, and then add our credits to our payments that we made, and then subtract that from the tax that we calculate, right? Shouldn't that be here somewhere? We don't pay tax. You don't pay tax on this form. Isn't it weird? Ladies and gentlemen, let me introduce you to a whole new animal, the pass-through entity. You pass through income, you pass through expenses, you pass through tax credits. Nothing stays here. It all gets sent someplace else. This return should not incur any tax. Is there a spot where we can calculate tax? Yes. Should you incur tax on this form? No. Okay, so we're not going to calculate tax. We're not, well, I guess we can end up with some sort of credits. We can end up with some sort of money being paid on our behalf, but it doesn't belong here because the 1120S belongs to an S corp, and an S corp is a pass-through entity. It does not pay tax. Keywords here, at the entity level. Pay tax at the owner level. Exactly right. So what this is all about
is it's categorizing income. So why is it important that we categorize the active income, the operation of our business, and separated that out from the passive stuff? Because we're not paying the tax here, it's going to be paid on your tax return, and we don't know when we're preparing this what you have in the way of active or passive gains or losses. It's all going to be taken care of and reported and tax paid on your return, not on this return, on your 1040. That's right. So you're going to have a spot on your 1040, I believe it's Schedule E, where you report the income from past credit. That's why it's so important that this all be categorized like this, because those decisions as to whether the passive loss, for example, is going to end up being able to be deducted because it has passive income that it can be put against. It's not being done here, it's being done there. Here. Yeah, I think those seem sometimes.
I said that's so smart.
Yeah, I guess.
For a smaller.
For a smaller business, yeah, because you don't want to end up with a C problem where you can't get the income out without paying double taxation. So this is what avoids the double taxation, because we don't pay tax at the entity level. If you get money out of here, then you pay tax on your return only. Okay. All right. I love sunflower seeds too. You need to speak up. Have a little confidence, even with the seeds in your mouth.
Oh, horrible call. What is yours?
I love it. Below that, a tax K2, shareholder pro rata share. If it's an international, we're not going to monkey with that. Post 1986 depreciation adjustment, we're not going to worry about that. That's all AMT, alternative minimum tax. Items affecting shareholder basis, tax exempt interest. Once again, that's something that it's a reconciling item if you think about it, because it's not going to appear on the front page, and we didn't have a section in here on the upper portion of Schedule K. So tax exempt interest would be down here. Non-deductible expenses, so you could theoretically have numbers there. Distributions, attached statement if required. Repayment of loans, foreign taxes paid or accrued. In the very end of Schedule K, shareholder pro rata share items, investment income, investment expenses, dividend distributions from accumulated earnings and profits, other items. And then income or loss reconciliation, combine the amounts on line 1 through 10 for the far right column. Those results subtract the sum of accounts of amounts from 11 through 12 and 16F. So we have to do that calculation. There's nothing to reconcile it up against. Schedule L, the balance sheet. Nothing different here than, this is all per book, by the way, so this isn't going to be different from the way you keep it for GAAP. It's also exactly the way we would have reported it on the 1120 itself. M1, reconciliation of income or loss per book with income or loss per return. So this is very similar to what we saw with the M1. We do have an M2 here, analysis of accumulated adjustments accounts, shareholders' undistributed taxable income previously taxed, accumulated earnings and profits, and other adjustments accounts. This has a lot to do with making distributions when you don't have accumulated earnings. I'm not going to monkey with this. If you want to learn this, I'm going to let you do it on your own. I don't want to spend the time on it. Okay, that's the 1120F. We've already done huge chunks of it. We've done the 4797. We've done the 4562. We've done the 1125E. We've done the 1125A. We've done the Schedule D, a little bit different, but it's still going to be very similar to the D we saw for the 1120. The 1120S is just a little bit different because it has us reporting things in different places. But the supporting schedules are all really, we've done it. It's really not that different. How does it get to the taxpayer though? K1. Because that's the Schedule K that's on the return here. In order to get it reported out to the taxpayer, we need it to go on a Schedule K1. All right, now, get used to this. Everything we're going to do from now on, the rest of the semester, is going to be a pass-through entity. The taxpayer that you see on the test on Tuesday, the C corp, is going to be the last time you're going to see a tax payment. From now on, they're all going to be pass-through entities, and you're going to have Schedule K1 with each one of them. Now, notice it says Schedule K1, Form 1120S. Every K1 is going to be unique to the tax form that it supports. Okay, so this is the one that is used for S corps. It's going to be a K1 for the 1065, which is partnership return, and when we get to the fiduciary tax return at the end of the semester, it'll be a K1 for Form 1041. All right, so let's take a look at this. Partnership or shareholder share of income and deductions. Part 1, information about the corporation, corporation's employer identification number, corporation's name, address, zip code, IRS center where corporation filed its return, corporation's number of shares beginning at the beginning of the year and at the end of the year. So part 1 is information about the corporation, not about the owner. It's about the corporation. Okay. These forms, these K1s, will be attached as schedules to the Form 1120S. Okay. So if we have 10 shareholders, we're going to have the 1120, we're going to have the 4797, the 4562, the 1125A, 1125E, and then 10 K1s. Each individual owner will receive a K1 that is unique to them, because it's not going to be like we were talking about partnerships before, and you said, oh, don't you just split it in half and put it half into each of their capital accounts? Yeah, probably. But with an S corp, it's going to be allocated based on your number of shares. You may not all have the same equal number of shares. You may have 100 shares out there. One guy has 20, one person has 10, one person has 5, one person has 40. Everything's going to be allocated based on the number of shares. That's all. All right. Part 2, information about the shareholder. Shareholder's identification number. I was going to say social security number. I'm very close to being able to say shareholder's social security number. Who's allowed to own an S corp? Individuals? Can they own shares in an S corp? Other corporations? Can other corporations own shares in an S corp? Not generally. I believe there's a certain type of trust that exists out there that's allowed to own shares in a S corp. And decedents of states are allowed to own shares in an S corp because they're the successor to an individual that originally owned. But this is not unlimited. It's a very small group of entities that are allowed to be owners of S corps. Most of the time, most of it's going to be limited to individuals. All right, shareholder's name, address, current year allocation percentage. What is my percentage of ownership? So, what percentage of the corporation's total income and expenses am I getting? H, shareholders' number of shares, beginning of the year, end of the year. I, loans from shareholders from this shareholder at the beginning of the year and at the end of the year. So this information here is unique to the owner, shareholders themselves. Part 3 is where we start talking about the income. See, this is like You guys are familiar with 1099s. You know, if you've done any kind of personal tax work, you know that you've got 1099 in, 1099 div, 1099 miscellaneous, or, you know, whatever you're getting. We did talk about 1099 OIDs in this semester. 1099 or a W-2, it's an informational return that is given to the IRS, not necessarily paying any tax with the 1099, but the 1099 is informational, telling the IRS, hey, we gave Austin $100 worth of interest this year. And you're going to get a 1099 INT that says, hey, we paid you $100 in interest. Don't forget to report it. That's what these are. Okay? We're just passing that information out. We're passing it to the IRS as part of the tax return, and we're giving it to you for you to use on your personal return. Okay. So part 3, this is your share of all the reportable items. Number 1, ordinary business income. Your percentage would appear, not percentage, but your percent of the dollars would appear there. Okay, so if you made $100,000, that's what it said on the K1, and you had 10%, you have $10,000. Net rental, real estate income, other rental income loss, interest income, ordinary dividends, qualified dividends. You guys know the difference between ordinary dividends and qualified dividends? Have we talked about that? Has anybody talked about that? Okay. This is another one of those tax preference things that's out there. Would the United States government prefer for you to own shares in a United States-based corporation or in a Saudi Arabian-based corporation? Probably an American company, right? How can we possibly encourage you to invest American? How about we give you a tax break? So a corporation that is tied enough to the United States will be a qualifying corporation. And dividends that are paid from that qualifying American corporation are going to be qualified dividends. Okay. So when you receive your 1099 div at the end of the year, let's say that you've got money invested with some investment, Edward Jones, Merrill Lynch, whoever, and you get your 1099 div at the end of the year, and you're invested in all kinds of things. Ordinary dividends are going to be all of the dividends that you got. So if you got $1,000 worth of dividends in total, ordinary dividends would say $1,000. If 750 of that came from qualifying U.S. companies, then 5B would read $750. So you didn't get 1,000 plus 750. You didn't get $1,750 in dividends. You got 1,000, of which 750 is qualified. Okay, these are always included in that. The reality of it is qualifying dividends are taxed as capital gains. You actually report it on Schedule D capital tax. Okay, royalties is 6. 7 is short-term capital gain or loss. 8, A is net term capital gain or loss, collectible 28%. 8C unrecaptured section 1250 gain. Section 1231 gain, other income. Eleven is section 179 deduction, 12 is other deductions, 13 is credits, 14 schedule K3 is attached to the check, 15 alternative minimum tax items, 16 items affecting shareholder basis, 17 is other information, 18 more than one activity for at risk, 19 more than one activity for passive. Okay. Want to see something interesting? Here's your K1 and all of the various categorizations, because remember, all we're doing is reporting information and categorizing on this return. If you read these categorizations and line numbers, they're identical the K1. Because all you're gonna do when you get to here on the Schedule K on the 1120S, you're gonna summarize everything that happened, total, everything that happened for the company, for the corporation, for the S corp. And then you just transfer it to the owners. So if we have $100,000 of ordinary income and you own 10% of the company, all we do is multiply that number by 10%. Line 1 goes on line 1. Line 2 goes on line 2. Line 3 goes on line 3. All the way down. No magic here. It's really easy. You just have to do the math. It's all just your allocable portion. I'm running out of time. Oh man, they don't give me page 2 anymore. There is a page 2 to the K1. And page 2 is actually instructions to you, the person who receives the K1, and they will tell you the information that is listed on line 1 goes on schedule such and such, line such and such. The IRS form is actually beautiful because if you flip it over, the instructions are there. It tells you where to take the information from this return and put it on your personal return. All right, so that's the 1120S. We're going to do a lot more with it when we get back after the test. Remember, Tuesday is going to be the test for the 1120.